Welcome to The Money Manager. In the studio with me is Director of Morningstar, and that is Victoria Roovers. Victoria, we're going to talk about manager research today, not one particular fund, but the theory behind Morningstar's business and the way that you choose managers and all the effort and all the process that goes into a final conclusion. So let's start, first of all, with the state of the industry. First of all, we were sort of chatting off air about the big managers versus the boutique managers. Boutique managers seem to be doing rather well at the moment.
They have been doing very well, Lindsay, and manager research is a process, and I think particularly important now, where you have over 2,000 unit trusts in the industry. You have 169 shares to choose from. So if you think from an investor's perspective, the universe of investment vehicles outside of shares is just so large. So you ask the question, boutique managers have been doing well. Why have they been doing well? Well, it's very easy to pick, and what we find most investors do is pick a fund that has done well.
Yes.
And so the manager research we conduct is forward-looking. It's quantitative, and we try and identify those funds that we believe will outperform going forward with an associated
So
level
do you
of
block
risk.
out the previous history? Is that what you're saying? You start from day one. You can say, well, like if you're an economist, inflation was 4.7%, but that doesn't matter. That was 2 months ago. We're looking at 6.1% in the future. Do you adopt the same approach?
No, we believe there are 5 critical areas which help us determine future performance. They really form the spine of our research, and we don't look at any one in isolation. But the performance pillars, so of these 5 pillars, we come up with an analyst rating, which is really a summary expression of our forward-looking analysis. And the 5 pillars are the parent,
Yes.
the process, the people,
Yes.
performance, and price. Conveniently, they all begin with a P.
Yeah, I was going to say, did you just run out of P's? That's why there's only 5 pillars.
Exactly. And the performance pillar is the area which people tend to place the most emphasis on.
Right.
And in Morningstar, we actually place the least emphasis on that. And from a South African perspective, one of the main reasons is that the average manager tenure is around 5 years.
Yes.
So if we think of the last 5 years, it's been a relatively easy time for managers in this market. But more importantly, how do we know that historic performance will be replicated going forward if we only have a 5-year track record?
I was speaking to somebody about a PSG fund the other day, and I think as one of the managers that has been managing this fund since inception is now moving aside.
Jan
For
Matano.
example, yes, moving aside, I think it is in March. And I said to the person, how important is this to you? It's very, very important. We're going to be monitoring the succession plan, etc. You do the same, obviously.
Absolutely. For us, we believe the parent pillar is of utmost importance. We want to make sure that our investors are aligned with managers of money that will continue to treat them well long after they've actually made their initial investment. So we place a lot of emphasis on, is the parent, are they good stewards of capital? Do they have a strong investment culture?
Yes.
Are they more interested in generating investment returns or growing revenue from a business side?
The two are linked, though, of course, aren't they?
They are, and that's why we look at areas of alignment of interest. So, for example, we believe that performance fees are not necessarily the best alignment of interests, because to pay somebody more for doing a good job doesn't necessarily incentivize them. What is their time frame?
Yes.
One of the metrics we like to look at is co-investment. So how much of the manager's personal money is actually invested in the strategy and the fund in which they manage.
Yes. So you talked about performance not being the top of the 5 Ps. So let's say that's number 5, although it's probably not fair to do that. What of the 5 Ps is the most important? Is it parent?
Yes. Parent, people, and process are the most important. By far, they carry the most weighting. Just to touch on performance, there are many ways to slice and dice performance. And what we do like to look at when we look at performance is to ensure that the performance the fund generated really is in line with what we would have expected given different market conditions and given the process of the fund. And we also look at particularly downside deviation. So it's good if a fund has performed well in good times, but how do they perform during bad times?
Yeah.
So yes, just getting back to your question, the parent, the stewards of capital, understanding the investment culture, that is of utmost important to us. The people, who is managing the money, are they the right fit? Does it suit their skill set?
Yeah.
You often find fantastic equity managers being given multi-asset mandates, which really constrains them because their skill set lies on the equity side. And then the process. And no process is immune to periods of underperformance. And what we want to understand is the predictability of that process. So what can go wrong? Is it being applied consistently? Does the manager have the freedom to stick to their process during times of underperformance.
What happens in the industry now if you've got, let's say you take 3 different large managers? Are all the people at the different large managers all the same? In other words, this particular manager has this type of approach to managing funds, and even if you're a brilliant fund manager and you go for an interview there, if you don't have that approach, you either have to change your approach or you just don't get the job. Does it work like that? Are they not a zombie-like culture, but very different styles in very many different places, I would have thought?
Lindsay, you would be amazed at how different the investment processes are and the investment teams are within the industry. There is absolutely no one style that is dominant. What we are finding now is almost terms, so for whether it's value or quality or growth, value means different things to different managers. So many managers will say they're value managers, bottom-up stock pickers, but they will have a very different top 10 shares to another manager who says they are a value manager. And so it's interpreting and understanding that style.
That's an ingrained culture within an institution, is it?
Yeah, so you have different types of investment teams. So some teams, for example, at PSG, as you mentioned, they will have a buy list of funds. Alan Gray is the same, and managers are allowed to buy off that buy list of funds, and that buy list is constructed really through an analyst. It's a very detailed process for a share to make it onto the buy list. You then have other houses which have a more a multi-counselor approach. For example, Ford, I think we mentioned them a few weeks ago, where each portfolio manager is allowed to, given the fund has been through an analyst process, is allowed to build their own portfolio, and the ultimate portfolio is a combination of those, so the multi-counselor approach. And then you do get other asset management businesses where there really is identified key man risk, but investing is it's art and science, and you can't necessarily, you do pay a manager for their flair. So there isn't that absolute stamp from the manager of what they want in the portfolio. So you like a bit of a maverick
occasionally, do you, as long as that sort of approach is well placed?
No, I wouldn't say we would invest with a maverick. That would really just fall under the one pillar. So it would come through on the process side, and we wouldn't necessarily mark the manager down for that. But as I mentioned, the parent, if that is a manager within a large industry, a large firm, the parent would be of more importance there.
Here's a page in front of me. It says gold, silver and bronze. What is that?
So we take our analyst rating and we determine, is it a gold, silver or bronze? Now, those are funds that we have a very high level of conviction will outperform their benchmark going forward with an associated level of risk. A neutral or a negative are funds that we would not invest with. A neutral is a fund we are indifferent about, but there are areas of concern.
How many do you reject?
Quite a few. By definition, not all funds will outperform, and what is very interesting, actually, Morningstar globally, so they've been doing this for 30 years, it's the DNA of the business, how it was formed, and what they have found is if you bell curve all the funds that have been rated around the world, there is, I think, a 5% in gold. The majority sit in neutral or bronze. There's a handful in silver and a sort of a handful at the tail as well.
What about in South Africa? Let's say that of 100 funds that you're looking at, how many would be gold?
We probably would have no more than 8. Yeah.
And how long do they stay there?
They stay there for some time until something material changes. We hope to do, and we spend hours and hours. The work done up front is extreme, and we place a very high level of conviction in our analysis and in those managers. So it's not a rating that would change unless, for example, a key man left, and we weren't comfortable with a replacement. If there was deviation from the process.
Importance of portfolio construction is then followed by style box. Maybe you could sort of amalgamate the two there. The importance of portfolio construction is a very, very obvious statement.
So when we talk about portfolio construction here, we're talking about blending different managers. And what is interesting is the work we do ensures that in the short term, not every manager in our portfolio will be performing fantastically well, but we aim to ensure that the portfolio has consistent top quartile performance. So the importance of the portfolio construction is to understand the drivers of returns from different funds. And if we can understand that, then as managers and their process may be underperforming in the market, we've got other managers that are taking the lead. But if we invest with consistently top performing managers, there's a much smoother investment profile for the end investor.
Style box is an interesting one here because you've got you use three different companies to illustrate your style box process. Again, that's that word again. Anglo-American, Naspers, and African Bank, which is right outside of the circle. Just describe that.
So, Lindsay, I think one of Morningstar's key strengths is they take incredibly complex data and they create an easy visual. So that image you have in front of you is Morningstar Style Box. They trademarked it, and what it does is it looks at shares, and for each dot on that page, there are 12 metrics that have gone into it to say, is it a deep value share, up to growth on the x-axis, and on the y, the vertical axis, is it a mid-cap, small cap, or large cap? Sorry, other way around, small, mid, or large cap. And then the share is plotted. And that actually is Coronation Top 20 in June last year. Yeah. And as you know, that fund can invest in 20 of the top 60 shares on the Aussie. And we were interested to see that African Bank was where it should be, a small cap value share, just before it actually went
under, yeah.
And so what we do on a portfolio construction side is we're constantly looking at the underlying managers and saying, they say they're a large cap growth manager, or they say they're a mid cap value manager. Are they sticking to what they say they're doing? Yeah. And we can drill down to the shares. And that's a great visual. It's a simple visual, yes, but the amount of work behind that is quite enormous.
How many fund managers in this country or worldwide say that we are this, but actually you have a look at it and say, well, actually that's not true?
There are a lot.
Yeah.
There are a lot. And particularly now during prolonged cycles of, what we're seeing in the resource cycle, for example, is in one of the things we look at on the parent and on the people side is, do managers stick to their conviction, and are they given the freedom to stick to that conviction? And sometimes, and it does happen often, managers just change because they just can't stomach it anymore.
What about a resources manager that's been long of certain stocks for 2 years? That's the conviction, that's what they have to do, and historic data tells them that they should be doing what they're doing, but their performance is so woeful. Yeah, I mean, that's we're human beings, for goodness sake.
So if you're a resources manager, then I think that would be fine, because you have to invest in them. If you are a multi-asset manager, and your goal, you've stated to investors that we're going to ensure inflation plus returns, then resources shares probably shouldn't have been a significant part of the portfolio from the beginning, because where were those earnings going to come from? So they may be cheap, they may be value, but you have to marry value with the cycle if you want to ensure consistent returns.
We've only got 30 seconds left, unfortunately. Okay. Victoria, just wrap this all up for us, please.
So I think manager research has never been more important than it is now. You could have picked a fund over the last few years and been lucky. Luck can perform in the short term, but we're very confident that the only thing that will differentiate luck from skill in the long term is a disciplined research process and picking consistent performers.
Victoria, thanks very much for your time this evening. That's Victoria
Ruvers,
Director